Morning, everybody. It is Thursday, October 25th, about 8:35 my time here on the west coast of the good old US of A. And welcome, everybody. Dr. K is with us here today, as always. When is he not here? You're out there, right, Dr. K?
I certainly am.
All right, floating out there in Cyberland. Anyways, yeah, I got to tell you guys, I'm in heavy short. This market I have been playing this very heavy for at least the last 3-4 weeks, and very, very well so far. And I'm going to talk a little bit about some of the strategies I've been using, and maybe it'll help some of you guys who are trying to short this market and trying to short individual stocks get a handle on how you handle some of the volatility. And you probably know, most of you probably know that I've had problems in the past shorting. In March of 2009, of course, I was way too short when the market turned and stayed too short too long and really got plastered. Very nicely, I might add, but nothing that one can't come back from, at least the way I like to play the market, as long as I can play it my way. But right now I am playing it my way, and you guys are looking at my home screen, my monitor home screen for my e-signal, so you guys can see what I'm looking at today and what I'm actually trading. The stocks in the top 3 boxes on the left side here are what I'm actually trading and represent different portfolios. I got my short basket here and a couple others that are more concentrated. But let's look at what's going on essentially with the market. If I can find my little NASDAQ chart, you can see basically what we're trying to do is hold the 200-day moving average. You've had 2 rallies now, 2 upside rallies, and I have to admit that shorting has been very easy because the market is providing me these very nice morning rallies, and overnight I won't hold anything short more than, say, 20 to 30% total of my account equity. So overnight I don't really want to be too heavy short, because studying the market since 2009 on the short side, I've noticed that really the biggest dangers are getting whacked on a bizarre QE gap up in the morning, and trying to avoid those by using a short-term system that allows me to trade very easily and very simply intraday on the short side is really what I've gotten down to working out as far as my short selling goes. And so it's taken some time, but in the last 3 months it's yielded. I did a calculation today. We're about up 50% just since this market started to roll over, really, which I'm going to say was closer to August in some stocks as they began to break down. But that's the sort of thing that can be done if you want to be a maniac. Those who are shorting in say more sane ways, I think, can make 15, 20, 30% pretty easily if we get a sustained bear market. But we'll see how this goes. You're still really in the nascent stages. You can see with the NASDAQ sitting above the 200-day moving average, you are set up to break the average and come down on top of this level here, this sort of choppy range back in July. But the thing is, I don't see this as being a big potential area of support because it's not very coherent. You only have these little peaks. It's almost like falling onto a spiked bed to me, and it can just easily fall through this. So I think you could see the market move down to 28.50, maybe undercut some of these lows after going through the 200-day. That's what it looks like it wants to do right now. To me, that's what it feels like, and that's what my short trades are confirming to me, okay? And I'll go with that until that tells me otherwise, and right now it's just telling me to hit this market hard on the short side every day that it opens up. But I do have a coherent and rational method, at least I like to think it is, for putting out those shorts. So anyways, that's your NASDAQ chart. Let's take a look at the S&P 500. I know I have it in here somewhere. Well, I did last I checked. Here we go. S&P is looking better than the NASDAQ. That may not last. One of my strategies has been to buy the SPXU here on these rallies and looking for a move to the 200-day. You do have some support down at this level. Let's pull up this little, which is around 1400, and the lows of this little handle, you might call it. And so you could undercut that. That could coincide with a bounce off the 200-day. That's what I'm looking for next. Doesn't mean it has to happen, but that's what I'm looking for. And as long as the market moves in my direction, I'm going to continue with that. Dr. K, do you have any comments on the market direction model and where we are in terms of the overall movement in the indexes and what you see in terms of ETF opportunities, including not only the major market indexes, but any specific ETFs outside of those, such as your beloved TVIX or VIX model?
Yes,
so if you want to go into that,
sure.
Take over.
First of all, the model, as we all know, has been on a sell signal. There is no evidence that the market is recovering anytime soon. Leading stocks and the general market averages continue to sell off. The selling pressure is is very well, it's very noticeable across the board. So the model is going to stay firmly in its sell signal. Now, in individual ETFs, in terms of stocks like Apple that are continuing to break down, and it looks like it's going to head to its 200-day and test it out. I think there's weakness, pronounced weakness in a number of technology stocks. So if you're going short the Qs or related ETFs, or buying the inverse Qs, I think that probably bodes better performance potential than, say, S&P related ETFs. And then as far as and that would also include the Russell, because when the markets are weak, the Russell tends to be more volatile and also tends to have steeper drawdowns than its counterparts. So the Russell 2000 related ETFs, the inverse ETFs, are also viable here, or have been viable, I should say, since the signal, as we recommended. Now, as far as the TVIX UVXY model, that is the last two signals have been big winners, and as long as this downtrend persists, I would imagine that the current signal on the UVXY model will remain as it is, because these things tend to trend. Although on the current signal, basically, if you look at a UVXY chart, you'll see that UVXY and related ETFs like VXX, when they go into an uptrend, it's very short-lived, because that corresponds to a market that's falling. And when markets fall, they tend to fall faster than markets that rise. So it makes sense that the UVXY uptrend the signal would be much shorter-lived. And the current signal is how many days old? It's not a very old signal, and it probably will not.
5 signals or 6? I mean, six days.
Something like that, yeah. And so my based on the way this model works, I would imagine that this signal will also be short-lived and maybe last another several days at most, because the idea is when the market falls apart, if we do get a nice little correction here, that's probably the place for the model to go back to cash and take the money and run, because the UVXY would spike, and you'd be looking at, again, a performance profit of potentially 50%. And the model actually has two fail-safes. It's got the minus 19% fail-safe, but it's also got an upside fail-safe that takes it out. In other words, that's at 48%. So in other words, when I've used this model in real time and in backtest, I've noticed that once you get 48% gains on a signal, it's better to take the money and run rather than to get greedy and sit on the signal, because that's often when the market will have a reaction rally and bounce, and then UVXY will head lower in a hurry. So that 48% was roughly the number that seemed to be the best fit. But that said, of course, I'm going to intervene at times, and if the market's until the market shows signs of stabilizing, the UVXY model will stay on its signal, and the UVXY will be allowed to spike as high as it wants to go.
Okay, let's see. What are we looking at
right
here?
now? It looks like the market is taking a. It had a nice little run lower today, and now it's trying to find its footing again.
Yeah, I'm looking at a 5-minute on the ES minis, and you can see you're breaking down. You're getting a long downside bar on heavy volume. That might tell you you're exhausted short-term on the downside, but that's just intraday. We'll see how this thing pans out. So far, it's been pretty weak. And among my targets, let's take a look at some of these. Apple, I've been campaigning since it failed at the 700 level, but really it's been a kind of a day trading affair, and I come in and hit it. But now, since it's violated the 50-day, this rally I thought was very shortable right up into this area here. It didn't get quite as far as the 50-day, and now you're starting to violate the breakout area in here, and I'm not sure where you want to draw this, like this, or you want to draw it like this. I think I'd probably use this upper line first, because this one's going to coincide with the 200-day moving average. So my thinking is that the stock is headed to the 200-day moving average. We'll see what happens on earnings after hours. It's going to be a question. Dr. K and I were talking about this earlier, how much we want to hold short into earnings, if at all. So I do think, what was it, Dr. K? We figured maximum of 15, 20%. We might, depending on how much we're up on the way we've been playing the current Apple short position. But Was that right, Dr. K? 15-20%, right? We were thinking.
Yeah, I think that's about right.
Yeah, and that's going to depend on where it closes. So, we don't know. We've already been making good money on this thing, shorting it. Do we want to be pigs here and it has a 50-point rally, 8-10% rally tomorrow? We'll let you know by the close. But I think everybody has to handle the position according to their own risk tolerance or their own risk parameters, because we know that anything pretty much can happen, and you never know how the market's going to interpret a weak earnings report. Because we did have something like Intuitive Surgical looking pretty ugly going into earnings, and it looked like it was going to break down on this day here, and then you'll notice that it did turn and go higher. Now, the one thing I'm watching for here, because you'll notice it's on my list over here on the left side, is whether this is going to turn into a situation that turns out to be some sort of a right shoulder, because it's actually very common. You'll see a stock look very strong. They'll start to stall at logical resistance, and right now I think you're working at a 550 area as your logical resistance. We can go back and say, look at price line, trying to act similarly, trying to come up here and having a couple of pocket pivots and looking better, and running into resistance right along the 640, 650 area here along the turn today, and then it rolled over. So I'm kind of keeping an eye on Intuitive Surgical right now and see if it does the same thing. Now, if you're bold and brave and manly, you can come in here and try and short a position in Intuitive Surgical using either the high of today at, say, 548, or just the high of, well, I take that back. Today's, no, using the weekly high. I got to make sure I'm looking at what I think I am here. Using a weekly high, at 551, it's pretty close, and you can do that, and I think that's definitely playable here, and it could break down, and probably if the market does break down, this will turn out to be a right shoulder. And I would look at it, is this a head and shoulder? Is this a little shoulder here? If you, blink your eyes twice and rub them hard, maybe you'll see some patterns start to form, but it's more of a late-stage failed base. So you're right back up to the breakout point of this late-stage failed cup, and this could be a logical point for the thing to roll over. So, in fact, I'm going to test a position in the stock short right now, actually, as we speak. Just a small position here. I'll come in with about 15%, and we'll see how that goes. So we get filled at 540.90. We'll see how that works out. So is that right? Yeah, and so I've got about 2% less than that on the upside for my stop. That's very tolerable in my book. Okay. Now, I could have gotten it off earlier. If you look at, one thing I like to use is just a simple 5-minute chart, and I think you can study a lot of different intraday charts and devise all kinds of cool little indicators on the short term. What I've noticed is that when I trade on the short side, I'll generally tend to make a lot of money very quickly, and then wham, the market slams me on the upside, and I end up giving up a large chunk of my profit, sometimes more than what I made, and end up in the red on the whole operation. So I basically came up with a very short-term way of doing this using a 6-period and a 20-period moving average cross, and I've noticed that on days when you really get some juicy shorts off, the market cooperates. If you look at, say, Apple this morning, the orange line is the shorter time period, and you can mess around with all kinds of different ones and see what you come up with. This one I found has worked for me. To me, it's not some model that is going to work for all eternity. It just seems to work in this environment, and it took me a fair bit of time to kind of work it out, at least for my own trading style. And I think a lot of models, Dr. K and I were talking about this earlier, a lot of models do need to dovetail with someone's trading psychology. So in other words, if you're using something like the MDM, and you know the MDM on a 1x ETF basis can draw down 16, 17%, I think we know it can draw down more than that now, you do have to be willing to sit through those drawdowns, but if you don't have the psychology for it, then forget it. It ain't going to work for you. I don't care how great the model is, because at some point, and probably at the very low, you will pull the ripcord and bail out just when the model has a massively profitable signal. So I think any system you use, whether it's intraday or daily or whatever, it has to be suited to your psychology. And one of the things I like to do on the short side is I try to keep my upside risk as minimal as possible, 1, 2, 3%. I really try to stick to that, because in 2009 I got killed by sitting through too many gap ups. There were several, and if you go back to that period, let's see if I can pull some of these up. I don't know how easy this will be to do, but let's take one stock that I was campaigning on the short side back then. I was doing very well with it. Let's see if we can go all the way back to 2009. And I talk about this in the book as well. But you had these gaps that where do we just go? What years? Here's 2009. Is this? And look how this chart kind of funks out here. But it's looking like it's going to break, and then you have these massive moves, these instant moves up, and they're very quick. And if you sit back too long, if you even go to the bathroom for 5 minutes, you can come back and be down another 5%. And so I wanted to set up a system that would prevent a lot of this sort of stuff. And so just using a simple intraday moving average cross and trying to gauge where you are, like it's even tanking today, with some of these stocks is a thing to do. Now what I'll do, notice on the Apple chart, you do come down here, and it's confirmed by this little MACD line, which is the same intervals. Nothing fancy. It's not magic. It's just something I've come up with, and it seems to work. And usually what happens is intraday, I start looking at things after 6 a.m. my time, so half hour before the market opens, and I may actually start shorting stocks pre-open if I start to see a break pre-open and there's some volume comes in. But you can see right at 6:30, Apple was up at 6:22, and right at that point, boom, it broke down through the blue line, which is the 20 period, and then the 6 period broke below the 5 period. And you notice that it's never crossed back above since. And at this point, basically my trailing stop will be across. So right now I'm looking at, say, 614 as my trailing stop, and it'll move down with me. And once it starts to come back up through, I'll just cover and go away and wait to come back later on in the day. Because the other thing I've noticed is the first 2 to 3 hours of the day, you can make a fair bit of money on the short side, and then the market will spend the rest of the day going sideways. You're not making any money except you're nursing all these positions you have on the short side. I would rather clean them out, go back to cash, and then rethink on a later sell signal later on in the day. And we'll see. You can see how some of this might work yesterday. This is yesterday's action. I did the same thing with Apple. Opens above, crosses here, shorted here, boom, boom, boom. Now here's the turn, and you would just cover and go away until you start to see another valid sell signal. You see, you get one here and doesn't really pan out, so you could be back and forth or actually taking small profits or just going back and forth with a position intraday. And then here you get this move. You better be out of the way there. Now it rallies this morning back up to 622. But actually, forget this. That's not relevant. But you can see how this gave you a signal here, and then once this covered, you're not getting much action after that period. This is a close. So again, I got to make sure I know what I'm looking at here, but you kind of get the idea of how I'm using this. And I don't know, Dr. K and I were talking about this, is this sort of system going to work forever? It seems to work so far, and I have to say that on the short side I will probably use a similar system, and I may adjust the moving averages and the periods and all that based on how the environment changes, and try to move with that. But the one thing that's very important for me is, number one, avoiding those morning gap ups, because they get you behind the 8 ball early in the morning. You don't really want to do that, so I don't go in overnight short very much. And if the market cooperates, which it has been doing beautifully lately, it's handing you these gap ups to short into. And what happens is, if we even look at the market this morning, here's your gap up on the futures, and it breaks right here, and it hasn't looked back ever since. This is a 5-minute chart. I think I pointed that out already. Now we're trying to get a bottom here, but we'll see whether that pans out, because you're still underneath this level of support, which I think on the futures or on the S&P was yesterday going into the close. So this might be resistance. So I'm just kind of watching these right now. You can set some of these up on your screen if you want with whatever system you're using. I know we have a friend, Dave Eccles. Dave, I don't know if you're out there, but he uses a system like this. He uses a couple other indicators intraday, but it does work pretty well, and I think Dave's been doing okay with that. But my point is simply that there are a lot of ways to skin a cat here, and really what it boils down to when you work a system, and it may take you a while to work out something that works well for you, because it all depends on your trading psychology, and I think you have to pair your psychology with what's going on. This morning, we talked about Google and Priceline. These 2 days of selling volume, that's, I think, Dr. K, am I right on this, or am I full of baloney? To me, I'm looking at a chart, and I'm trying to go back on Google. I think that's the largest single day, 2 days of selling volume we've ever seen in the pattern. So you have one day bigger here.
Yeah, but you had about 24 million collectively over both days, and I would say that is potentially the largest, certainly in the last year and a half. If you look at a weekly chart, it looks like it's the biggest weekly spike since late 2008.
Yeah, and I don't see any 2 consecutive days where you see that sort of selling going on. And so, that's pretty deleterious in my view. And so I think on the 50-day, whoops, where do we go here? Where'd you go, Google? There he is. Come back here. Maybe Google is a she. I don't know. Anyways, so you get this big breakdown. That looks pretty ugly to me. You find some support here, and now you're just flagging it. So you're basically forming a flag, and I'm looking for a downside break. And I'm watching the 10-day moving average here. Actually, it's up here. This is a shorter 5-day moving average. Not so relevant. I'm just kind of looking at it, so I just have it up here for fun. But you do have potential to rally back to the 50 days. So my approach here on an intraday basis, how I will handle this, as soon as I get this signal this morning, it took a little while to work itself through, get a clean signal, get short the stock here close to the 680 level, and it's starting to come down. And so I'll come after it there, but I may be out if it gets back above today's high, which is, what is the high today? 675.29, is that right? Am I looking at that right? I think so. Then that's my cover point. That's pretty tight. So you can see that that's kind of how you do it. Coors, same thing. I told you guys last week I've been coming after Coors. I've actually been playing it long and short the last few days based on these intraday signals. And you can see it gave a clear signal this morning at around 55.30. I got off my short somewhere around this area right here. Now it's come down pretty good. You hit a low. You're testing, coming back to test the low. But notice how I'm not getting this crossover. So I'm hanging out. If it does cross above, then I'll probably back off and see about shorting it later on today, or maybe not at all, depending on what it does. So that's basically how I handle these things intraday, and I come in every day and hit them. And the market has been very, very cooperative in this regard. So I've noticed that when you do have a weak market, up openings followed by declines are generally the sign of a pretty sharp or serious bear phase, and that's, I think, when your probabilities of success on the short side are highest. And so what you want to be doing is noticing this, obviously, which is what you're here for, and as we point this out. And so you do have a sense that the market is weak, and so it just kind of hands it to you. And the other thing I've noticed about short selling is when it works, it's pretty easy. And when it's very tough and you have to sit and nurse things, then that's probably not the time to be in, and you're always waiting for that point of impact where things start to break down in earnest. So, and I don't know if we're at that point. We could also be at a bottoming point with the NASDAQ, right at the 200-day moving average if this holds. So we're kind of on the lookout for that. And that's kind of where this is at on the short side. A few of these others that we're talking about, Priceline was another one we're talking about in the same vein. It did get some support. I think this is like 533.72. Is that right? 553.72. I'm sorry. And so you're looking for a breakout here. Again, you could just short this using the high of today, which I think is 570.71. As a quick stop, and what you're basically looking for is a breakdown. Now, a good example of how you can sometimes be waiting for these is in Bed Bath & Beyond, which did a similar breakdown and then a reverse or bear handle. I'm sorry, bear flag, which is kind of an inverted handle on an inverted cup and handle formation, but I won't get into that. It's just an inverted flag. And you can see now it's broken down through these levels, but it takes a little time. It doesn't necessarily work right away, but if you get into the right position, you can keep working it and be in position when this thing starts to break. And notice also that you could have shorted here, it comes down, you could have covered overnight, shorted again the next day in here, and it comes down. And it's very continuous, and it's allowing you to work these positions with low risk. And so I haven't really had very big drawdowns at all, 1 or 2% maximum on the way up while I've been shorting. And so I credit this very simple system to helping allay some of that. So, but like I said, this is my own thing. I'm not telling anybody here to use it. I think you need to go out and do some experimentation yourself in terms of understanding your own trading and what you need to do to keep your risk very tight. And I think that's the key thing in short selling. So, other stocks I'm keeping an eye on. LinkedIn I've got as a short coming up into the this area here, up in the 110 area, which is a prior breakout area. They come out with earnings, I think, in early November. And this is looking pretty weak. Lulu, another one. You had this break through the 50-day and then a very weak wedging rally back up here and barely gets up to, doesn't even get up to the 50-day moving on, just starting to roll over. Notice there is some support at the 200-day line. So it might bounce along here for a little while. Just because it's coming down today does not mean that it's cemented, success is cemented in place here just yet. we did have some stocks, a Bible gap up supposedly. But Dr. K, I had a question for you on this, and I was skeptical of this yesterday, mainly because the big issue for me here with the stock is when you look at Bible gap ups, it seems to me that when they occur down lower in the pattern or at the initial say breakout point coming from a long base, that's when they have the most power and the most reliability. I think when you're getting into this area, you might be late stage, and I think there's much higher risk in buying something like this. What are your thoughts on that?
Well, I wouldn't call this late stage just because if you look at the overall weekly pattern, it really hasn't had a chance to really get going out of that really big base it formed starting in 2010. Now, off the bottom, it's kind of begrudgingly gone higher, and then after it hit new highs, it took right off. So what we're seeing really is a second, well, I would call this actually a third earnings-related Bible gap up. You had the first one on April 25th, and then you had the second one on July 25th, and then the third one yesterday. What I didn't like about this is Bible gap ups generally should not close at the low of the trading day. And this one did, but the advantage is that you're out today. I mean, you wait around for maybe 2%, 2 or 3% porosity, and then you cut your position. So your loss in the trade is probably contained within 5 or 6%, assuming you didn't buy at the high. And yesterday's market action was not so terribly weak that this should have closed at its low. So that was a warning sign. And not only that, if you initiate a position on these Bible gap ups at the open, you could do a half position at the open, and if it comes off and then closes at the low, it's probably a good idea to cut at least half your position. So in other words, you would only be left with maybe a quarter position of your normal size position, and then today you'd be selling out the remainder quarter position. So you keep your losses mitigated that way.
Okay, so I won't get in trouble with you then if I shorted the stock yesterday?
Well, if you saw a short entry point, then that's a different animal altogether. And your shorting is sometimes on an intraday level. So and obviously Bible gap ups are for the you're trying to catch a long-term trend.
Yeah, I mean you can see this thing. It had a nice move in the morning, and then once it broke down here, it was just sayonara from there. But no, that's not really a very clean break. But my tendency is to be very wary of buying something that's too obvious in this market, and I tend to think that is too obvious. I tend to think this sort of thing is too obvious because you're in a bear trend, and as we pointed out, everybody, yesterday in our morning report, we point these out because they are signs of strength objectively. Okay, you can argue about how viable they are. That's another issue altogether. But in the context of the environment, they're probably not because you're in a market downtrend. Agreed, Dr. K?
Absolutely. I mean, yeah, as far as taking action on the long side when the model's on a sell signal and when the market's in a clear downtrend like we are now, you really do so at your own risk. And we do say if you're going to go on the long side because the stock somehow has done everything right and bucked the market downtrend, go ahead. There's nothing wrong with taking a half position and testing the waters, because there are some stocks, and namely I'm thinking of the biotechs in I think it was the first half of 2005 that bucked the market weakness, and you could have made money by buying those special key names. So there's nothing wrong with getting dipping your toe in the water on the long side when the market is in a downtrend, but please do so very sparingly and don't find yourself sitting in 4 or 5 positions on the long side in a downtrend, because the odds are very much against you.
Yeah, and just have your out point. I mean, like Ross Haber likes to say, you can do any trade you want as long as you have an out point that keeps your risk to a reasonable level, and that's the key with any trade. So, a lot of people send us questions. Can I buy this? Can I short this? Can I do this? Can I do that? Well, yeah, as long as you have an out point, if it's reasonably thought through and there's a technical basis for the trade. So, if somebody's asking us for our blessing to tell you that something's going to work, that's not really what happens. It's unrealistic. Somebody says, Whirlpool, is this a blow-off top? No, I don't think so. You're only up, 3 out of the last 5 days. 1, 2, 3. It's not. I don't know if it's a blow-off top, but you don't short into these. These are not the short sale setups you're looking for. Okay. How do you determine the number 1 stock in any industry group? Seems like a lot of work comparing SEC filings or reviewing industry literature. Not at all. In fact, Dr. K, you might want to comment on this, because I think this kind of like gets off track for us in terms of our methodology, because we don't look at SEC filings and studying a company to determine if it's number one in its industry group. We go by price performance. And if you look at a certain group, you want to know what the leader is in that group, it's the stock with the highest relative strength. Dr. K, your thoughts?
Yeah, it's a stock with generally the highest relative strength, combined with top-notch fundamentals and combined with liquidity. So, in other words, you disregard relative strength 99 stocks that went from $2 to $8, and you disregard stocks that generally have a daily dollar average volume of under, I'd say 15 million or 20 million. You want to be in liquid names. And once we get into a small cap environment like we were in 1991, then you can start relaxing some of these daily dollar average volumes, because there's going to that's the kind of market where I might be holding 16 stocks in my portfolio, because some of these are going to double or triple, and they may very well be small cap oriented. In other words, their daily dollar volume may be somewhere around 15 million. Anything under that, I probably wouldn't touch, even if we are in a small cap environment, because now we're talking pretty thin names, and there's much more risk associated with those types of names. There always has been more risk associated. So given the huge basket of stocks that are available to us, why put your portfolio in unnecessary risk if you don't have to?
So we got you guys out there?
Yeah, did you turn your mic off?
Yeah, I did. So I've been talking for the last 30 seconds to myself. But, I love to hear myself talk, so it works out really well for me. But someone's asked about Expedia, and it has violated the 50-day moving average. Bill, you can edit out that pause there when you put this up on YouTube. But in any case, it looks, I never really liked this pattern. It's a cup and handle. It looks too perfect. And, of course, it tries to break out and slam. That's it. So it could be a short. I kind of like Priceline better because it's weaker, but it looks like it. Since Guggen Priceline our show, is it reasonable to test the short side of QQQ with the SQQQ with a stop below today's low? I don't know. I just would have bought the SQQQ or the SPXU on the MDM sell signal myself. So, I don't know. Dr. K, you have any thoughts on that? You want me to read that again slowly?
Yeah, go ahead.
Since Goog and Priceline are shortable, is it reasonable to test the short side of QQQ with the SQQQ with a stop below today's low? I've been on vacation and looking for setups. I mean, my initial comment is it doesn't look unreasonable, since you do have your loss tolerance or your risk tolerance firmly in mind in terms of using it.
Yeah, that sounds all right. That sounds all right, because especially if you haven't been able to get into this downtrend, knowing that you have a tight stop on is not a bad idea, because this market, the Nasdaq's testing, it's knocking on its 200-day moving average for the third time in 3 days. And the last 2 days were both distribution days. So it seems that the market can't muster a bounce. So the odds seem to imply that the next stop for the Nasdaq is going to be under the 200-day, which means going along the SQQQ with a real tight stop is not a bad idea right now.
Yeah, I mean, you could use the high of today on the Qs or something like that, or the last couple 3 days as your stop. That's pretty reasonable. So. Somebody says, why is this correction in leading stocks getting hammered any different than what we have seen over the last 2 years? That these markets have snapped back hard, made new highs on the leaders. Google, Apple have been bought and went on to make new highs. Apple corrected over 17% in early 2012. 70 straight, frustrated and confused. Well, you don't know whether it is or not, but I would say I'm not going to assume it is. I only know whether I'm making progress on the short side or not, and if I am, and a fair bit of it, then I know I'm in a playable market on the downside, and I'm ready to turn with the market when the evidence points the other way. So I think if you come in, the way these markets are these days, is if you come in when there's confirmation or things look pretty obvious one way or the other, then that's often where the market will turn. So You know, I just remember that old Police song, too much information running through my brain. I kind of changed that to too much confirmation running through my brain, too much confirmation driving me insane. And so I don't think that that necessarily helps you in this market one way or another. You have to be ready to move with it, especially when it looks ugly. So, you know, you have a point in that you don't know if you can trust the markets that are going to snap back because it has been a QE market. But I would point out that why is it that ever since Fed Thursday here on the Qs, September 13th, why is it we only had couple more days of rally, a little bit of rally, and the whole thing rolled over right after the Fed announced QE eternity? So QE for as long as it takes on a month-to-month basis.
Yeah,
why
it's
is the
almost like
market
QE
selling
is not
off?
working anymore because you can look at a weekly chart of the Nasdaq and you can highlight the times that QE was in effect, and when QE is in effect, the market is in an uptrend. Now QE3 is in effect, and we're in a downtrend. So that is vastly different from the other two QE periods, which is a big warning sign. I mean, this, you know, that I think that's a very material difference right now between now and then.
Yeah, and you can also see it in the leading stocks. There are a lot of leading stocks busting wide open. You know, and some that were impenetrable or just very steady, you know, steady eddies to the upside. Looking like Alexion breaking down. You know, Biogen was another one starting to break down. Amazon was another steady stock to the upside here, and now look at how it's broken down. Almost looks like it's headed for its 200-day moving average. That said, are we potentially in a position for the stocks to rally? I think if you look at a lot of stocks, maybe, but I'm going to let that play out on its own because I have my system for covering myself or covering my positions later on in the day. So.
Right. Also, we don't know if the market's going to unravel like it did in August of 2011. Where it really came apart hard, and you know, if you didn't short that rally, if you didn't take the model sell signal, then you would have missed out on the biggest profit the model had all year,
Right.
and that would have been on the basis purely that, well, in the last 10 times the market always recovers, and therefore I'm not going to trust the signal, and that's an understandable reaction, but that is why trading the model to a T is challenging because you have to withstand a number of false signals before you get that true one. But that's what makes the difference in terms of the model's profitability. That's how the model has been able to beat the markets over every cycle. And this year is definitely the toughest year for the model in the history of the model. So, you know, let's see what happens for the remaining part of the year. But you know, the year has been, you know, a great learning experience, and it's also ushered in these shorter-term time frames, and it's also ushered in some substantial modifications to the UVXY model, which, you know, going forward now, I believe holds some good promise.
Someone asked if you should short Monster on a bounce. I don't know. You know, if you wanted to short it, I guess you could using today's highs or stop. I don't know if it's necessarily going to head lower. It's been getting whacked the last few days on news that someone died from drinking their drinks, their energy drinks or whatever. I don't know. My brother and his two sons, both teenagers, actually the older is much older, they love that they're always drinking those things, and I don't see either one of them or any three of them looking like they're going to die soon. So I don't know if this is a trend or what, and sucks. Going to blow apart, but what we do know is that stock was already in a head and shoulders. We talked about this a couple of weeks ago, that it could be shortable up in here, and if anybody did short it, you've done pretty well with it. But at this point, it is shortable here if you're trying to enter here, but your chances of success are lower, so you have to recognize that, and you obviously want to use a tight stop. And I would simply use the high of the day if I wanted to short it, but it's not something I want to short. I like, as we pointed out earlier today, and when we sent out our short sales setup report, I like these inverted flags. Now, they may not work either. It may just go sideways for a period of time. You may have a rally to the 50-day. But again, I'm operating on the basis that everything is ready to snap back in my face, and I want to move quickly and get out of the way if that starts to happen. And so at the same time, though, the system that I'm using allows me to come in and try to test these because you will get a nice break in some of these on the downside, and they work out pretty well when they do. So you also have to keep working on them. How should one handle a stock like TDG, for example? Well, I think that's pretty simple. If you just wait for a violation of the 50-day moving average if you own it, you know. I don't really care for the fact that it's broken down, and if you do have a good profit in the stock, the way the market's acting, I don't see why it wouldn't hurt to just lock in that profit and look to re-enter on a new buy signal. Your thoughts on that, Dr. King?
Yeah, I mean, when it had that gap down 2 days ago, sometimes I'll just sell right at the open, no questions asked. I just don't like that kind of action in a leading stock. And as you can see, it went right through the 50-day, and you never know how much further these things are going to slice through the 50-day. So on a gap down, I would say at least sell half your position. Um, and if you didn't sell any of it, this is a big flaw in the pattern now. So I would keep your stops very tight. I mean, yeah, you could use the 50-day violation if you really want to hold true to the 7-week rule, and that's fine. There's nothing wrong with
Right.
using the 7-week rule. But also, I mean, in this kind of downtrending market environment, I would probably have my stops tighter than using the 50-day as a violation. I would probably look to sell this thing if it undercuts the 50-day again. And right now it's trying to hold the 50-day. So that would probably be my sell stop, which would only be about 1 or 2% away from where it's trading right now.
Another part of the question is that, what do you do with a stock like this that triggers sell signals and tanks because a special dividend takes effect and damages the chart? I don't really see where a sell signal has taken effect since we're using the 50-day moving average as a ultimate downside selling guide, and even though it did break the 50-day, it did not close below it. So remember, a violation of a moving average first has to close below it and then move below the intraday of that intraday low of that day. So for example, if we had closed down here, closer to 126, say, down here instead of up here above the 50-day, then the next day if it had moved below the intraday low of this day here, that would be a violation. So it hasn't triggered any sell signal. So, I don't know what there is to have to handle there actually. But I think whether stocks declare dividends or whatnot, all
Well, yeah,
stocks are subject to weird little sell-offs and whatnot. So I think you're sticking
if
to
the
a
if the gap
violation.
down is on something like a secondary offering or announcement of a dividend, then that's not a material negative for the company, and that of course has to be taken into context. In which case, that kind of a gap down should not be sold because there's nothing wrong with that type of it's not deleterious information about the company that's occurred. So you don't count those as gap downs. You just sit and
Right.
continue to use the 7-week rule.
Some of that is a CMG is short. If you want to be kind of late to the party, I guess, but it looks pretty ugly. You had a gap down. I know Ross was shorting this, and he made some pretty decent money having into earnings, actually. And I don't know what he's doing with it now, but, is it shortable? I guess if you want to short it here and use the high of the day, which is, what is that? What I don't like about this chart is the fact that it has no labels. Let's see if I can find the labels. Forget the short labels. Let's go with the long labels. There we go. Ta-da! Okay, so the high is 247.53 or 244.41. So if you shorted here, you could. It's way down there, and you did gap down, but you do have some near stop out points, so you could go for that if you wanted to, I guess. But for my money, I'm looking for something to bust wide open out of a pattern, so that's already weak as well. So I mean, CMG is definitely weak. But again, I like some of these other ones. You can see the Apple's coming down. Coors is still weak, hanging around 54. We got Priceline weak around 560. Everything else continuing to move lower. There's no real movement off of the lows for most of these. So continue with some shorts. Is the TIDX short target 2503? I would use that. I mean, that's the low. Let's see if we can make this a little smaller here. Here's your low. I would look for these lows as being broken. Now, the one thing here is that you are undercutting some of these lows, so short term those might be really tight short term cover points, but I think you're looking for more than that. I might take my trailing stop up to the 10-day moving average at 26.78, however, which will keep you a little bit tighter. It's not too far from here, price-wise, but percentage-wise, it's a ways, another percent or two. So that's giving you some very tight cover point there, which I think is necessary in this market because you are down a ways, but you're breaking down from this broader pattern, which to me just looks like a big old rolling top. And you have two big, kind of ugly, well, you might say one, two, three, four big ugly cups. Someone might see a reverse head and shoulders, which works briefly, but we don't really operate on that basis. But I think this thing is starting to break down. Notice you're closing near the lows every week. Volume has not been heavy, but I think this thing will bust with the market. So again, right now I think I'm more inclined to go after things like Google and Priceline than TIBX, but I think TIBX is viable as well. Do you agree with Bill O'Neill that we will start a 3-year bull market run in the next 12 months based on market cycles? I don't think I have to agree or disagree with him. It'll happen when it happens. I'm not going to assume that it's going to happen. I think that I know Bill is doing something in Cincinnati, talking about the super cycle that we're going to start. I think I'm not sure, but I'm going to guess, knowing what I know from Bill and where he might travel during an election. He might be going to Ohio because it is a swing state or a battleground state. He might be going there to help campaign for Romney. I'm going to guess that he has supported Romney, or he is supporting Romney with both money and possibly even his time. So I don't know. So I'm guessing that's where he is. But I think this whole super cycle thing also ties in with a change in leadership and a new Romney administration. I think that may be what he's doing there in terms of trying to spread the word. So I don't think you have to agree or disagree. I think it's an interesting theory, and I hope Bill's totally right, because if he's right, we're going to make a ton of money in the next few years, and I would certainly love that. I'd like to party like it's 1999 all over again. And so let's just say that. You know what? For now, you're damn right. I agree with Bill. Don't you, Dr. K? I agree with Bill.
Yeah, I'll jump on board. Yeah, anybody who's saying we're going to have back to the 1990s again, trends that we had in the 1990s, that would be fantastic. So We'll see. When it happens, it'll happen.
But I can tell you from working with Bill, Bill has this nose about things that will sometimes be uncannily correct. So, I think he understands cycles a lot better than I do, having lived through quite a few more than I have as an investor. And so I think he understands that much better than I do, and probably has a much better intuitive sense than Dr. K and I put together. So, I'm all for it. So I hope he's right. Thoughts on Baidu? I'm not sure. Here's the thing with Baidu, is that it's in a position of short. I think they announced earnings, is it today? When is it, Dr. K?
Let me see here. According to according to Wanda, it's on the 27th.
But that's Saturday, so it's probably today. Is it today? Anybody know?
Possibly tomorrow, then.
Yeah, whatever. Well, tomorrow's Friday, so I'm going to guess it's either today or next week. Whatever. It's above the 50-day. I don't know. This one I'm not so sure about. I mean, it probably will. Maybe it busts on earnings, maybe not. I don't know. So it's kind of neither here nor there. And it's in China, and China's been showing some better numbers lately, and so that might be a place where money hides, or it may just blow apart on earnings. So if you try to short it here, I would say if you're going to short it here, you use the highs of the last couple of days or the last week or so as your stop on the upside. If you want to hold it into earnings, maybe it does blow apart on earnings, in which case you would probably do the maximum 10-20% position if you can stomach that. So anyways, let's get through some more.
The earnings release is Baidu releases on the 29th after the market.
Let's see. There's a lot of questions here. We only got 10 minutes. Racks. So, I think some of these questions by now, if you've been watching these, you should be able to figure this out. This is breaking the 50-day moving average. It has not technically violated it, but we know that it has violated the 10-day previously, and you were using the 7-week rule, so you should have been out of it a while ago. Everybody says they agree with Bill. My watch list had close to 50 names 2 weeks ago. Now it's down to about 15. Similar situation. That tells you something. Baidu's on the 29th. That's next Tuesday. Is that right? Or next Monday? Yeah. All right. Look, there's like 50 IMs coming in on that. Okay. Let's see. I think I got through all the questions. Let me run through these one more time. Make sure I did get them all. No, there are a few. Sorry. Let's try to get through these very quickly. Okay, I mentioned our friend Dave Eccles. Dave says, I use the 8 and 21 EMA same way, but daily time frame dictates which stocks I'm in. That's right. So did you copy my method, Dave? Maybe it's just that great minds think alike, huh? So I know Dave's come a long way as a trader, and I know he quit his job last we checked. Hopefully he still dumped that real-world job, which Dr. K and I, we highly espouse the concept of not having real jobs, so that we try to maintain that ourselves. And for those of you who still have real jobs, there's nothing wrong with earning your living as far as I'm concerned, but the sooner you can become a trader and not have a real job, the better. Did FB have a bottom fishing pocket pivot? I don't know what to think about FB. I think it's just building a base. I wouldn't be buying this. So you got any thoughts on that, Dr. K, real quick?
No, I just don't like. It's a bottom fisher, so I'm going to avoid it for now. I mean, if Facebook becomes viable in the future, it'll trace out a constructive price volume pattern here, and then issue a pocket.
So I don't know if I wouldn't try to buy it. It seems like just news oriented, and just when Mark Zuckerberg says that there was more potential, or there is more potential in mobile than people recognize, that may be true, but we'll have to see how these guys execute still. And I think with the lockups coming out or coming off for a lot of the insiders, you're going to see some overhead pressure on the stocks. I don't know how fast it's able to move. I'm not playing it, and I'm not long anything. Gold and silver, I think we covered this already. Last week we were looking at them sitting at the 50-day, but they broke through and they violated. So, you know, if you bought down here and you still have a profit, I think this is your final sell signal, and you're just waiting for the next buy signal if and when that ever occurs. Your thoughts, Dr. K, on that?
Yeah, I mean, right now, I mean, because of the violation, let's just sit and wait for a renewed entry point, because we don't know how far down these things are going to trend, especially in a weak market environment. Weak markets can take these things lower, because weak market might be telegraphing that QE is not as strong a force as we thought, and maybe that the weak market has an effect on putting selling pressure on SLV and GLD. So let's wait for the dust to clear until we re-enter these ETFs.
I think that's an interesting question. Apple was a real leader. The leader usually breaks last when we go from bull to bear markets. Thoughts on this interesting exception? Well, the theory about it's not really an exception, because I don't know if Apple was the big leader. It is a big leader, but also Apple, within the context of where it's been over the last 3 years, it's had a long run. So you are getting long in the tooth here. Mutual fund ownership is very high, and I pointed out in other webinars previously over the past couple of months that you are starting to see some of the big funds, some of the big axes in the stock, like the Fidelity Contra Fund, for example. It's run by Will Danoff, who is an O'Neill client and probably still is, and was back in 2004 when we were first really loading up on the stock, and he got real big in it then. I think he's had over a 10% position in it, and it's worked out very well. But I noticed they've started to sell, and so have a number of other Fidelity funds that started buying it. And so I think you're a little bit saturated. That whole rule, I don't think this is an exception or a confirmation or whatever, because what happens is a leading stock will be acting well, and then finally it'll have a break off the peak as you get to the lows of a correction. So they're the last ones to get hit. But Apple's been getting hit for a while, and even I think maybe as the market was going higher, it's had a couple of bouts of selling pressure, and I don't really think that applies. I'm just taking it on its face and not trying to overanalyze it. Any thoughts there, Dr. K?
Yeah, that's basically wraps it up. I mean, Apple was a leading stock, and it still may very well be if the market can right itself here. But in the meantime, as far as it's in a downtrend, just like the market. And Apple used to lead the market, and maybe the market now, maybe things are going to switch. When Apple gets weak, it stops leading, and the market then can get back on its feet, and we'll see what happens with Apple. Apple is a $572 billion company, and the question is whether it can continue to grow at the pace it's been growing. It seems like a very mean feat for any kind of company. And as it stands, it's the largest cap company in the U.S. market. So how much bigger can it really grow? I'm a bit skeptical, and there's a flip side argument that Apple has a massive cash in its war chest and has a number of products that they are waiting to roll out over the next few years that are also going to be groundbreaking. But that remains to be seen. And another critical point: I saw the Samsung, the latest incarnation of Samsung's mobile device. The graphics, I would have to say the resolution on the Samsung probably is better than what we're seeing on the iPhone. In other words, they're using some kind of, I forget the technology, like mole technology, resolution technology, and Apple's using the retinal display technology. And I think Samsung's got Apple beat, and also Samsung is open source. So eventually, and I've said this before, when I probably get the iPhone 5 for now, but the next phone after the iPhone 5 will probably be an Android. because the open source platform always wins out in the end.
Good point. I like that. Somebody's saying here, let's see, what can you reiterate the period for the period after the intraday? Oh, I'm using a 6-period exponential and a 20-period simple. I think Dave was saying something. He uses a 6 and a 22 exponential. So, you know, like I said, there you can mix and match a lot. So, and I think the interesting thing is that Dave and I came to similar conclusions, and I think he can confirm this as well. And we didn't trade any notes on any of this, so we kind of did it ourselves on our own. And it's interesting how we came up with similar systems, which is cool. Dave says he's learned a lot from us, so maybe that's why he's thinking like a maniac like me now. So watch out, Dave. That can be dangerous unless you have deep pockets. Anyways, I'm interested in sentiment relating to the market direction model. I would expect a lot of cancellations after the drawdown. What is the trend in subscriptions? I can tell you that we did have a peak earlier in the year, but the bottom line is we know that trends in subscription rate, you know, increasing or decreasing, seem to be tied more to the market. And this has been a very difficult year for a lot of people, and I think people just get frustrated. But it's been holding very steadily, and I would say we're within 10% of peak subscribers over the past few months. But I think some of it is due. But it's surprisingly very low, and I always get on Dr. K's case like, your damn market direction model is going to destroy our business, but that hasn't been the case. And eventually,
well, there's 5 other services we offer, and so that helps mitigate, I think. Yeah. But the other thing is that people understand. I mean, when people say a lot of people who can't cancel will actually provide a reason why. And what I've noticed, the most common reason is that they're fed up with the market. They're not fed up with the model. They're not fed up with whatever the situation. They're fed up with the market for now, and then they always say we'll come back when the market gets better. You know, when it finds a discernible trend, and that's fair enough. That's fair enough. You know, the market has been probably the most challenging this year than any year I can remember. And the other most common reason is that it's a tough economy out there, and a lot of people have lost their jobs or they don't have the funding to afford the service, and that seems to be the second most common reason why people leave, and then they always say, "Well, we'll come back when our finances are more clear."
I like Dave's response to my comment right now about having deep pockets. He says, "My pockets are getting deeper." That's good to know, Dave. Now all you have to do is get married and watch those deep pockets disappear. Have some kids too while you're at it. Anyways, Fossils is short. I don't really see any break here. It seems to be holding up right now. I think it's a little too obvious. I'm after other stocks on the short side. So I think that is the last question we have.
Right on time.
Yeah, and someone says, I think when the market is most challenging, you have the opportunity to learn the most. That's why I'm here. I think you're right, and even we learn the most when the market's screwing us up. I mean, I learned a tremendous amount from getting my head handed to me in 2009 when the market turned on me and I remained short too long, and that's actually helped me refine my short selling techniques. And I think one of the first material results that I had was in May of 2010, where I was up somewhere between 80 and 100%. I've never done an audited calculation, but I can just eyeball it and see that it's up 180, 100% in 1 month. So also the success I'm having more recently has helped. And so yeah, for me at least, and I think Dr. K definitely will confirm this, the most challenging times are when you can really, the market will expose your weaknesses. And I think it allows, if you're open to it, you can identify those much more readily, and I think apply that in developing methods or refining your methods and your risk control accordingly. And I think that's the opportunity in crappy markets. Dr. K, your final thoughts before we sign off?
Yeah, absolutely. You know, in terms of dealing
Apple
with
breaking 610, there it goes.
Sorry, what's that?
Apple breaking 610. So
yeah, no,
I have a lunch bet with my trader that we're going to get below 600 by the close.
This is good. Apple looks so precarious here, like it really wants to. You know, it's like the 200-day is a magnet for this price.
Oh, look,
price
there it goes, back above 610. Maybe this is a low. Maybe 610 is the psychological support level. Anyways, Marty's trying to find some
tough markets. Definitely, you know, there are opportunities. Tough markets are that the pocket pivot was born because of a tough market in 2004 and 2005. because I was very frustrated at not being able to use O'Neill's style. I mean, breakouts were failing, and I was losing money, and it was very frustrating, and I never had to experience that in the 1990s. I didn't experience that in 2000 to 2002 because I was mostly out of the market in cash, and then 2003 was a beautiful, strong, trending market that persisted for, I think, something like 6 or 7 months. So 2004 was a wake-up call of, geez, I haven't seen a market like this ever in my, I started trading the market successfully in 1991. So 2004 was a whole new ball game for me, and that really, a whole year of that kind of really, go nowhere in money-losing trading, will do your head in. But instead, you go to the drawing board and you say, well, how can I fix this problem? And so viable gap ups and pocket pivots were born in 2005 as a result.
Yeah, in 2004, though, you had Apple and Google, and I played those stocks and was up very nicely that year, 82% in 2004. So that actually was a pretty year, but before that, I mean, it was pretty lousy. It was a very tough year. But it's interesting how, once again, we find necessity is the mother of invention. And so in these difficult periods, who knows what sort of methods or refinements the market will force you to make to survive.
Yeah, actually, the saving grace in 2004 was I was busy setting up the company and dealing with all these structural matters, so I didn't have the time I normally would spend to trade the market, and that was a saving grace. What I did notice, though, was the few positions I did have on where nothing was making money, or very few stocks were making money, and it's good that I was so busy with other things, so that did end up saving me money in the end. And then 2005, I had more time to focus on the market, and then this trendlessness persisted, and that's when I got real fed up, having a whole portfolio that went nowhere and was losing money. Because the pocket pivot, I believe, was born just third quarter of 2005, and then I finished, fourth quarter of 2005 was gangbusters because of the pocket pivot.
Yeah. Anyways, that's today's webinar. Hope it was useful, and I was trying to convey some of the things I'm looking at in terms of the short side and help you guys get a better handle on that. I'm a little wary, I got to tell you, about revealing some of my methods, but this is a very small group, less than 300 webinar members altogether, so it's a very finite group, and the only thing I would ask you guys, this is our group, this is our community. What we talk about here is between us, and as long as we can operate that way, Dr. K and I are always more than happy to share some of our methods with you that we don't share otherwise on the website, and we would appreciate, keeping it to yourself because this is an exclusive group, I like to think. Anyways, as always, you guys, there's Apple busting down harder. I'd love to see that. Now, just so you know, before I sign off, I'm going to use a 612.50 area, and this will drop with me as my cover point, probably, if this thing snaps back. If it just keeps going, I'm going to stay short. Anyways, you guys, thanks for showing up. We'll catch you next time. Take care, and good luck.
So long, everyone.